Hello and welcome to TheoTrade. My name is Doc Severson and this is the Theonite report for Thursday, August 18th. So starting off today's video with the S&P 500 ETF or the spiders, the question on the table is how and what can you trade in this super boring low volatility market? What kind of opportunities are there out there? Well, that's not an easy answer to that question because as we looked the other day, we went through the sector spiders and went through the 9 individual sectors here looking for opportunities such as with the financials, which have not really been moving at all for quite some time and are still stuck in a range waiting for central banks to figure out what they're going to do. We've gone through the technology stocks, which are sitting there super extended and more than likely to consolidate for a while here at these levels. We looked at the builders, which are offering a little bit of opportunity to the upside right now, but again, very close to all-time highs. We've looked at utilities. Utilities are pulling back a little bit, but there's nothing that really says anything bearish about this tape yet. Here's consumer staples that are right up against all-time highs. There's just no opportunity to buy unless you like buying into the highs, which I don't do. Here's the industrials, which are pretty much the same thing as the Dow. Again, right into all-time highs. No real room to do anything here, yet not showing any bearish signals. Here's energy. Now, energy, we're going to talk a little bit more about because this is starting to show some potential here, and energy has been so beat up over the last 2 years that maybe we're going to see a little bit of reversion back to the mean in the short term. Actually, the nice little rally that we had in crude is going to help that. So energy might be something that we look at in the near term. Here is healthcare, and again, healthcare is really not going anywhere right now. Very close to the all-time highs, not a whole lot of opportunity, yet at the same time, not showing any bearish signals right now. And here is consumer discretionary, again, right up against the all-time highs. So a familiar theme here, everything is up against the highs. Do you buy the highs in a market like this? Well, I can't bring myself to ever do that. So regardless of the fact that if the market melts higher, I can't just go long something into the highs. I've got to have some room to work with, or I've got to have some other signals that I can work against, which give me a higher probability of success versus just going along with the herd and going long. Okay, so let's go back to that sector that is showing some potential. What I like about the XLE is that right now, after all of this consolidation that it's been in for the last couple of months, what this has done is build up a lot of energy at a larger time frame. So this is going to sustain what should be a larger move here. Range contraction like this leads to range expansion. We're just now starting to see this breakout out of this pattern. Now, unfortunately, it's not going to have any sustaining power in the short term because all of this move, it's come all the way from the bottom of the pattern in a very straight line move. And so right now it's more than likely going to just set up with more of a consolidation pattern or just kind of grind to the upside until it gets a chance to catch its breath. But I do like the look of this. Now, just because we can't trade the XLE by itself because it's not showing the right signals doesn't mean that we can also look for other opportunities inside of that sector. So one of these is Schlumberger. It's tough to say that word right, but again, SLB is the ticker here. Now keep in mind the context of what's going on here. This is a monthly downtrend, so we're just coming off of a bottom and about to print what could be just another lower high. So we're just playing within this weekly swing here. This is all that we're doing here. Now this, to me, is a weekly uptrend. I see a series of higher highs and higher lows here. So that's good. Again, this is a monthly swing that we're playing inside of this weekly uptrend, right? And so taking a long against something like this, okay, we're not looking for it to go all that far to be able to get our 50% return on something like this. Now, another trade that we can look at is GLD. So GLD right now, again, it's the same thing as energy. We're just playing inside this monthly swing, and within the monthly swing, we have a weekly uptrend. Now, we don't have a tremendous amount of energy left in this weekly uptrend, but we are seeing a lot at a shorter term duration. So right now, just a short term, this is a nice little consolidation pattern. This is really more of anything looking like just a just a little triangle pattern sitting up here. And we should see, based on probabilities, we should see this break to the upside and give us a little opportunity for some movement. Now, how much movement? Well, if we look at the option chain here, maybe for going out to, let's see, the 23 SEP series. The 23 SEP series has an expected move of about 5 points. So looking for this to move from maybe 129-ish up to 134. That is not really that much of a move. We're not asking it to do all that much. We're not asking it to go up to 150 or anything like that. So this might be a good setup in the near term to be able to capture, again, looking for about a 50% profit on some of these trades. Now, the way that we're typically going to do these is with what's called an in-out spread, where we take one option in the money using the calls. So one option in the money, we're going to buy a vertical, and then one option out of the money with about a $2 wide spread and pay approximately $1 for this. In this case, we could probably get a 129, 131 for about 83 cents. We could maybe even back off of this a little bit and pay closer to $1, about 90 cents here. This is actually a better trade because of the fact that it creates a more neutral environment on the trade entry. Okay, so as you can see, we really have to sort of read between the cracks and what's going on in the market and identify opportunity where it is instead of banging a square peg into a round hole. Another example of what we can do is what's called a calendar spread. Now, what's important about a calendar spread is that it's long vega. And that's important because when you have extraordinarily low implied volatility, as we do right now, then you're walking into a trap if you set up iron condors in this type of a market. Now, here's an example of a stock which we had talked about on Monday, where we saw this after an earnings gap. So it had an earnings gap up here and held below the $100 price level. And so the thinking is that when we have this much range expansion to get this into an exhaustion zone, both at the weekly and the daily level, right? It's more than likely just going to waffle around at this price level for just a couple of days. So here's an example of where we can use something like a calendar spread, right, against this one. So here's a good example of a trade where we have a pretty decent amount of room to be able to work with, and this trade, if we had entered this on Monday, would have already been showing at least a 10% profit as of today, 10% return on capital put up against the trade. So this can be a replacement for the old iron condor when the markets just do not support it. Again, this is kind of the newbie trap that so many people fall into when it comes to options. So many retail traders fall into this trap when they go from very volatile markets that have usually at least a decent amount of implied volatility to make up for the fact that the realized volatility is bouncing around, right? But when we get into these super low volatile markets, right? So we have very low implied volatility, and we actually even have very low realized volatility on top of that. Range contraction like this usually does not last for very long, because what this does is, again, this is the proverbial coiling of the spring here, getting tighter and tighter and tighter until it just flies out of here in one direction or another. It can go in either direction, form these types of patterns, and it usually goes in the direction that creates the maximum amount of pain to the greatest number of traders out there. So if you see a pattern like this and you go, boy, I should be trading iron condors against this, you're going to find that, first of all, you're not going to get much range for your condor, and maybe you might get one off that is unmolested for a week or two. And it's going to give you confidence to set up the next one with double the position size, and then double that position size if you win that one as well too. And ultimately, it leads to ruin, as the market will find a way to wait until you put on your largest position size and then run you right over. And this is where we run into so many of these issues where the iron condor like this just within the space of a day gets run over. And this is a bad thing. You don't want to be doing this in an iron condor that is not risk managed properly. So for right now, that's really the answer for these boring low volatility markets. Right now, you have to go fishing for the right opportunities that give you at least a reasonable amount of reward to risk, number one. Number two, we don't want to be stepping in front of a strong trend. We don't want to be just shorting or outright being bearish on something that's got an extremely strong trend, because these have a tendency to go on for much further than people estimate. And then number three, we can look at some of the long Vega strategies as well too, to maybe replace those iron condor trades. And actually they can be very effective, because since they're right at the money, they can provide faster profits than the old iron condors did. Now again, there's no one perfect option strategy out there. However, there is going to be an optimum option strategy that matches the character of the current market. And that's something that we're always trying to do. We're always trying to match what the current character is to what our approach is towards trading options. Now, again, this will not last forever. We'll probably see the volatility come in, if not by the end of this month, certainly by the early part of September, and then we'll be happy that we're in some type of long Vega arrangement. And so you can expect to see a lot more of the long Vega strategies from us here shortly. So that is it for today's report. Thanks for listening. Thanks for enduring the low volatility and sticking with us. And we will talk to you tomorrow. Thank you.